Good morning and welcome to the Commodities Institute podcast. I'm Emily Costa. Today is Friday, January 9th, 2026. And as always, we're going to slow things down, connect the dots, and make sense of what's really driving global commodity markets right now. This has been one of those weeks where commodities stop being an abstract concept and start looking very political, very personal, and very powerful across oil, metals, agriculture, power, and even freight-linked flows. We're seeing a reset underway. Not a clean break, but a messy reordering driven by geopolitics, elections, capital constraints, and the simple reality that the world still runs on physical stuff. I want to begin in oil, but not where you might expect. Not with OPEC quotas or shale output, but with Venezuela, because what's unfolding there tells us a lot about how the United States now views energy as a tool of statecraft. Following the dramatic capture of President Nicolas Maduro earlier this month, Washington has moved quickly to assert control over Venezuelan oil sales. The stated goal is to refine and sell tens of millions of barrels of crude, with proceeds managed under US oversight, and, in theory, directed toward the Venezuelan people. But in practice, this is about leverage, supply security, and influence. What's particularly striking is who is advising the administration. Longtime oil executive and Republican donor Harry Sargent, a man who has operated in some of the world's most politically volatile energy markets for decades, has emerged as an influential voice behind the scenes. He knows Venezuela's heavy crude, its aging infrastructure, and its political elite intimately. And he represents a broader trend we're seeing again. Governments leaning heavily on industry insiders when they suddenly find themselves running energy systems. The United States is not just talking about allowing oil flows. It is talking about indefinite control of sales, bringing in major traders like Vitol and Trafigura alongside US oil majors. This is a profound shift. It blurs the line between sanctions, occupation, and partnership. For markets, it raises immediate questions. How fast can Venezuelan output recover from roughly 1 million barrels per day? What guarantees will investors demand? And how will this oil be priced into global balances if Washington effectively controls the tap? While oil politics dominate headlines, metals markets are wrestling with a different kind of power struggle, one rooted in scale and strategy rather than regime change. Rio Tinto and Glencore are back in talks about a possible merger that would create the world's largest mining company. The logic is clear. Copper demand is expected to surge as electrification, data centers, and artificial intelligence drive consumption higher. At the same time, supply growth is constrained by declining ore grades, permitting delays and capital discipline. But this deal is controversial. Investors worry about overpaying at the top of the cycle. They worry about cultural clashes between a traditionally operational miner and a trading-driven giant. And they worry about coal. Glencore still owns significant coal assets, while Rio has spent years simplifying its portfolio to focus on iron ore, copper, aluminum, and lithium. China looms large here as well. Any mega merger in metals raises antitrust questions in Beijing, the single largest buyer of industrial commodities. So even as copper's long-term fundamentals look tight, the path to consolidation is anything but smooth. Staying with metals, but shifting from boardrooms to battlegrounds, like the United States is also moving to reopen domestic mining in northern Minnesota. The Trump administration and Congress are working to overturn a Biden-era ban on mining near the Boundary Waters Wilderness area. The prize is copper, nickel, and cobalt, critical minerals for electric vehicles, power grids, and defense systems. This fight encapsulates the tension at the heart of the energy transition. On one side, environmental protection and local opposition. On the other, national security and supply chain independence. The legal maneuvering underway could make it harder for future administrations to impose similar bans, signaling a longer-term pivot toward domestic extraction, even in politically sensitive regions. From metals, let's turn to agriculture, where politics is once again reshaping trade flows. In Europe, farmers have taken to the streets of Paris to protest the proposed Mercosur trade agreement with South American nations. French President Emmanuel Macron has pledged to vote against the deal, citing fears that cheap imports will undercut European farmers and fail to meet local standards. This matters for commodities because trade deals determine who produces what, where, and at what cost. At the same time, global agricultural trade is quietly adjusting elsewhere. Brazil's egg exports surged to record levels last year, driven largely by US demand. When tariffs kicked in, exporters pivoted toward markets like Japan. It's a reminder that agricultural flows are incredibly adaptive, responding quickly to price signals, currency moves, and policy shifts. India's sugar market tells a similar story. After months of sluggish exports due to high domestic prices, a recent correction and a weaker rupee have reopened a narrow export window. Mills are shipping sugar not because it's highly profitable, but because they need cash flow. That subtle distinction matters for global prices, which remain near multi-year lows. Coffee, meanwhile, offers a cautionary tale about weather risk. Colombia's production fell last year due to heavy rainfall, even as exports rose. It's a reminder that climate volatility doesn't just threaten yields, it reshapes timing, quality, and income for hundreds of thousands of farming families. Let's move into carbon and power, where investment decisions are becoming increasingly strategic. American Electric Power's multi-billion-dollar commitment to solid oxide fuel cells is a clear signal that utilities are looking beyond traditional generation. Long-term offtake agreements, especially those tied to data centers and industrial customers, are reshaping how power projects are financed. Reliability, not just sustainability, is now the selling point. Contrast that with Norway's outlook for oil and gas. Production is expected to plateau through the end of the decade before declining as large projects wind down and new developments skew smaller. For Europe, this matters enormously. Norwegian gas has been a cornerstone of energy security since Russia's invasion of Ukraine. Any future decline will have ripple effects across power prices and industrial competitiveness. When you step back, a common theme emerges across all these markets. Control. Control of resources, control of trade routes, control of revenues, and control of political narratives. Whether it's Washington managing Venezuelan oil, miners consolidating copper assets, farmers resisting trade liberalization, or utilities locking in power supply, the commodity world is becoming more deliberate and more defensive. This is not a return to globalization as we knew it. It's a fragmented system where security, resilience, and influence often outweigh pure economic efficiency. For traders, producers, and consumers alike, that means more volatility, more political risk, and more need for deep market understanding. That's what we aim to provide here every day by slowing down and looking beneath the surface. That's it for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa. Thanks for listening, and I'll see you next time.